Welcome back, everyone. Let's look at Bollinger Bands.
Can't say I've heard of these before.
Me neither.
Well, by the end of this lesson, you'll certainly have a good understanding.
Okay, so what are Bollinger Bands?
Bollinger Bands are an indicator developed and trademarked by John Bollinger. It is a lagging indicator, but unlike the others we've looked at so far, it's used to measure market volatility. It consists of a simple moving average line, which you know about, with bands plotted 2 standard deviations above and below it. Bollinger Bands widen when a price volatility increases and narrow when it decreases. Because of its dynamic and reactive nature, it is used to identify potential price reversal levels by looking at overextended market conditions, as well as potential support and resistance areas.
You've lost me.
Let's look at how it's calculated to shed some light on it. So, let's get the ball rolling and look at how Bollinger Bands are calculated.
I hope this is going to be simpler than the SAR calculation.
Don't worry, it is. The starting point is a simple moving average, which, as we know, is... Anyone?
A simple moving average is a line used in technical analysis that smooths out the price, making it easier to confirm trends.
Well remembered. So from the moving average, 2 bands are added to standard deviations above and below the SMA. To do this, you calculate the standard deviation and multiply by 2. Then take that away from the moving average to get the lower band and add it to get the upper band.
Seems fairly simple, but what's the standard deviation?
Good question. A standard deviation is a statistical measure that tells us the amount of variation in a data set. For example, a set of prices that went 10, 11, 12, 11 and 12 has a lower standard deviation than one that went 10, 5, 15, 8 and 12, despite starting and ending with the same prices. With Bollinger Bands, we set the period that the indicator looks back over, for example, 20 periods. It uses the closing price, and this is the data set.
Okay, and how would we calculate a standard deviation then?
We won't go into how to calculate a standard deviation here, but if you want to read more about it, Wikipedia has a great write-up. There is also a link in the materials section in your dashboard along with the Excel spreadsheet of the calculation.
Perfect, thanks.
So, plotting 2 standard deviations around a simple moving average, Bollinger estimated about 88% of price activity will be accounted for within the 2 bands.
I don't get it.
Okay, let's show you on a chart. First of all, let's get the indicator up on a chart of the S&P 500. Again, this can be found in the drop-down under Studies. We'll check the settings quickly and confirm that it's looking back at the last 20 periods. So, in this case, the indicator is looking back at the last 20 days, and the bands are set at 2 standard deviations.
Yes, I see that.
The middle line here is the 20-day SMA. This is the upper band and this is the lower band. When prices aren't volatile,
Meaning they don't jump around a lot?
yes, when volatility is low, the Bollinger Bands squeeze in. When volatility is high, the bands expand. This is because the standard deviation are changing based on the price activity. Remember, each time the 2 bands get plotted, all it's saying is that with the new data set, looking back 20 periods, for about 88% of the time, the price should be within the bands. It doesn't mean it is definitely within the bands 88% of the time. Just that under normal conditions, we would expect it to be.
I'm following it now. So what happens when the price is outside the bands?
Well, that's when the indicator becomes really useful. Let's look at how traders use this information in the next video.